every person that we do a deal with, or every deal that we have done in the club, has always had a partner in the deal that is local to that area and who can directly manage it.
Yeah.
And so that is critical. We always have a partner who is local, no completely remote places. But what that does is it allows our club to have the flexibility. I mean, our club is invested in 10 different states right now. My tax return was 273 pages.
I can imagine.
State, because of all the state returns.
Yeah.
And so it gives us more flexibility in terms of looking in different locations, diversifying across geographies, diversifying across different asset and operators. But it's always important to have that local person there.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Daniel, welcome to the show. How you feeling today?
It's great to be here, Peter.
Man, it's great to have you. So I just found out you were on the other side of the country from me in Portland. Is that where you grew up, or did
Portlandia? No. Well, I grew up on the West Coast though, in the Bay Area, and moved out to Chicago. I was actually a trader at the Chicago Board of Trade. I was in the 10-year bond pit for a year, which was a really interesting experience. And I don't know if that's a topic we want to talk about here on this or not, but very interesting being down there with all the traders, kind of at the heart of the 10-year mortgage, which is or the 10-year treasury rather, which is what the mortgages are based on.
Okay.
And the short history of my life, I met my wife there. She was a French major. I found a volunteer job overseas in France, raised capital from nonprofits, and went over there and worked for a while. And when our first daughter was born, we moved back to the States to be near family. And then I got a job at Intel. And I think that's probably where we're going to pick up the story most of the conversation. But I worked as an engineer at Intel in Internet of Things and actually in artificial intelligence for the last 6 years, computer vision to be specific. So we didn't do a lot in generative LLMs or large language models, but we did a lot in computer vision. And I was a software developer there, and I also started the real estate club at Intel, and that's kind of where this portion of my real estate journey has begun.
Gotcha. Wow. Well, there's a lot to unpack right there. And there's probably, is there anything from your trader days that you still bring with you today? Any of the mindset or any of the ideas or concepts or anything like that? Or
Yeah, it was actually fairly formative because when I was there as a trader on the floor, the way that I originally got in there is my uncle had been a trader for 17 years, and you have to buy a seat on the Chicago Board of Exchange in order to be able to go in and trade in the pits. So I started as his page, and I did that for a bit like an intern, and I did that for 6 months or so, and this was in 2003.
okay.
So about 21 years ago. And he would buy and sell using hand signals in the pit. And the problem is that a lot of the liquidity within that particular, in the 10-year treasury, was moving away from the old time traders who were all using hand signals in order to trade to the computer screens. And now, to be honest, it's almost all on the computer screens. But so his strategy, he was an older guy, didn't like computers. He knew I was a software engineer, liked computers. So he brought me in, and I stood next to him with a tablet computer. He would, sell 400, then he'd turn around to me and say, buy 500. I don't want them to know what I'm doing. So we did that a lot. And then after about 6 months, I bought my own seat there and I traded for a while. And what I really learned there is that when you're in the static of the market, trading on a minute by minute daily basis, it's not a whole lot better than gambling, frankly. The price goes up, the price goes down. There's no real rhyme or reason as to why. It just depends on the number of orders coming into the market at the time. JP Morgan wants to sell 4,000 and you just bought, 30. There goes your position.
Wow.
So it also kind of struck me that there were a lot of people who were kind of junkies in the terms of, gambling. They had a gambling addiction. They liked being in the market. There were a lot of good people down there, but there were also a lot of, people using upper drugs and things like that I didn't find particularly attractive. And what I took away from that really was that I wasn't that type of investor.
Sure.
And I think every year since then, or every time I've changed investing strategies since then, I've always gone to more and more and more conservative, predictable, manageable ways of investing. And so coming out of that, I started buying, houses and flipping houses. And I did a little bit of wholesaling. And then in 2008, actually, I was lending and doing hard money loans to rehabbers. And at that time, I actually was living in France. And so I was doing hard money loans back to the US with a handful of rehabbers. And it was kind of early days in the internet for doing that. And so it was kind of fun to do that over the internet. But we would, I get a call from the rehabber. He'd tell me what the property is. He would send me, I'd actually pay for an appraisal. He'd get that done and send it to me. And an inspection report, and we'd lend on the property. And it was actually a pretty good business model. We would make 15% per year on our money, and usually a 6-month balloon, and it would come back to me, every 6 months with a couple of $1,000 like clockwork. So it wasn't bad until 2008, and the rehabbers all called me back, and actually they actually said to me, "Daniel, do you know that the market is crashing?" I went, "Well, I'm over here in Europe. I didn't realize that was the case." "Yeah, you're not going to get your money back." "Really?"
Wow.
So I said, "Well, I own the mortgage on this, so are you going to deed me the house?" And he went, "No, I'm not going to deed you the house." And I went, "Really?" "Well, what are we doing then?" And he said, "I'm going to take you through court for the next 12 months, and it'll cost you 12 months and $11,000, and you'll get the title from me then. Or you can pay me $11,000 right now, and I'll sign it over to you."
Wow.
"Really?"
Interesting.
So he extorted me basically for the $11,000 in order for him to sign it over. We put the money and the deed into an escrow account and swapped it. And that taught me a lot of lessons about be sure when your partners will be good in good times. In bad times, it's when people really show their character.
Wow.
And if your partner's not good both in good times and bad times, and for that matter, your business strategy, the type of products or investments that you'll offer, they have to be good both in good times and in bad times. But that's doubly so for people. So, and then where am I going with this now? I could just continue on with my story, or I can let you jump in.
No, I mean that's a fascinating story, and you've had a experience there that probably a lot of investors can relate to, but then on the other hand, there's a lot of investors that can't. You know what I mean? So that's definitely very interesting context to what you were doing then, and then kind of tell me how that's shaped your vision of what you do today. And I'm curious, with that property, what ended up happening? Did you add any work? Did you sell it on the market? I mean, what was your exit for that?
No, well, at the time, since it was 2008, property values dropped by 60%. It was in Florida. Okay. And they dropped by 60%, and I owned it free and clear, so I just rented it for like the next 7 years. I got good rental income off of it for about 7 years, and once the market had recovered, I sold it. So it worked out very well for me.
No, that's a good outcome. So it's a good point. If the property was able to be rented, and you were able to kind of cash out that way, it just took a little longer than maybe expected up front, but not a bad way. And I'm sure you learned some things. Now, was that your first foray into the rental space, or?
It was pretty much, yeah. I had done some smaller fix and flips before that in 2003 and 2004. And then that kind of led me to my discovery of what we currently do. I kind of have real estate in my blood. I really love it, and
Yeah, I was going to ask you that.
people about it.
how did you go from trade, computer science, trading, working at Intel? I mean, what led you to real estate? Especially, it seems like at a young age.
Well, so the truth there is it's family. My grandpa worked at my grandpa on my mother's side worked at International Harvester, which is a tractor corporation. And he was a tractor mechanic. He did that his entire career, and then mid-60s he retired. And my grandma, who was the real financial wizard between the two of them, said, "Hey, let's get together with your brother. We'll set up a partnership, go 50-50, and buy this 120 unit apartment complex that's down the street." And they did that in their retirement. It was a beat up old apartment complex, C class. They spent their hours rehabbing it themselves, fixing it up, and turning it into a really nice working property. And it hit me probably in my teenage years that the only reason my grandparents had an inheritance to pass down to my parents was because after my grandpa retired, they bought real estate. And that left an impression on me.
Wow.
And so I became a person who enjoys talking about real estate. And we haven't mentioned it yet. I founded the real estate club at Intel Corporation, which we just called the Intel, the Real Estate Education Club at Intel. And now it's publicly open. It's not just for Intel employees. I'm no longer working at Intel. It's a full-time job for me now, but now it's the Alternative Investing Club, and we're open to all types of investors. About 50% of the people in our club are accredited. 50% aren't.
Gotcha. So you still
That's on our last survey.
let's talk to that a little bit. So you said you were living in France, and then you wanted to move back home, and that's when you took the job at Intel, or?
Yep. Yeah,
Okay.
about 10 months after we moved back.
Okay. And were you still doing real estate on the side there, or was that something you got comfortable at Intel, and then that bug in the back of your mind kind of came back out once you were?
That's exactly what it was. Yeah, I just ran the rental house in Florida for a couple of years, and when we sold it off in 2015, I took about a year off, and then I got the real estate bug again, and that's when I started going into commercial syndications and industrial and multifamily type properties. And so I decided that I needed to have a way of building a network, and so I started the club at Intel, and we basically just brought educational speakers in every Friday at noon.
Okay.
And no, it was all over a video meeting.
At that time, too.
Intel does all of their meetings over video chat, basically. Even if you're in the same office, you usually at your desk on the video platform. And a lot of that's because a lot of the teams are very geographically dispersed, and it just makes the most sense. But what I found was even if I would reserve a room during the lunch hour down the hall and actually hold the real estate meeting there, which you were allowed to do if you were an official club, people wouldn't show up. Like even people that were in the same building on the same floor wouldn't show up. They'd be at their desk, eating their lunch and calling in over video chat. And first semester 3, we had about 12 people. And over the last 5 years or 4 years while we were internal to Intel, we grew the club to about 1,300 Intel employees. And so we have a good following of people there that show up every week for the educational speaker. We still do our meetings every Friday at noon, which are now publicly available. Anybody can come to them. Just go to alternativeinvestingclub.com and look for the Friday speaker meeting. It's a really good group now. And as a club, we've invested in 3,308 units acquired, multifamily units. Okay. And so we do a lot of education together, and then those people that want to invest together.
So I don't think most organizations, at least that I'm familiar with, have these kind of official clubs. How does that work? What was there other clubs there? Like, was there book clubs and chess clubs and things like that?
Oh yeah, they had all sorts of clubs.
That's awesome.
I mean, there's good cultural clubs for people from every different, part of the world. So there was, there was the people that come from China and India and all those ethnic clubs. Okay. Then there were a lot of the like sports related clubs. There was a tennis club, there was a choir, there was a chess club, there was
And they would meet virtual.
Toastmasters. So some of them would and some wouldn't.
Okay.
Chess club met during lunch in the cafeteria, playing their chess games there. But basically, I went to HR and said, "Hey, I see you have a startup club. I see you have a stock club. I want to run the real estate club."
Okay.
And they said, "Okay, as long as you go through the official process of bringing speakers in and fill out the paperwork that's required, sure, you can have your club. No solicitation, no advertising were my conditions, and 100% educational." And so that's what we did.
And how'd you go about finding speakers and things like that? Was LinkedIn so how long have you been running the club? And as it was now it's called the Alternative Investing Club. So did it transition from real estate to kind of a wider range at some point, or kind of get the story there?
Sure. So after I left Intel in 2023, the club actually came to me and said, "Hey, Daniel, we'd be interested in topics other than just real estate that we can invest in passively." And there are a good number of active people there too, but that was the wish. And so I sent out a survey, and it was overwhelming. People wanted to find other types of investments, including real estate. So real estate's kind of our core. Like I said, we've syndicated 3,308 multifamily units. We've got a couple of industrial properties. But we've started branching out into different types of investing. We've got a couple of oil and gas deals that have come up. We have a agreement with a solar farm group that they go out and they build solar farms. They raise their money in order to do that and then pay the investors back. Mostly, those are actually really tax efficient deals. They're not the long-term profitability is not great, but you get great tax benefits on the solar deals. We've had people come in and speak on how they run a fund for investors based on buying and selling expensive bottles of wine and whiskey. We've had people come in and buy fractional portions of sports clubs. We've had people come in and talk about the infinite banking, or running your life insurance as your own bank, basically. So we've had a lot of different discussions on different topics. We've had note investing funds. We've had every real estate topic you can think of.
Yeah.
Yeah.
Now, in the beginning, how are you finding speakers, and then today, how has that changed? I'm sure a lot of them come to you at this stage of the game, but back then, was LinkedIn what it is today? Were you going on there?
Honestly, I was
people to come every Friday.
I was two ways basically. I was a podcast junkie, and I would often reach out to people that I enjoyed listening to and invite them to come. The other way was just going to in-person conferences. So in 2018, I joined a multifamily mentorship program, and they charged an arm and a leg, and maybe two arms, and I got to know a lot of people there, and there were about 150 people in the group, and I set up a podcast, and I interviewed every single one of them.
Wow.
In 2020, that built a pretty good network out. And then a lot of referrals, and I'm still a podcast junkie. But and also people that I find that are, it's not just that I find them on a podcast. They're interesting because they have companies or businesses that are doing interesting thing in investing. So it's really about finding high quality people to bring into a high quality audience. And it's always we've been really lucky. We've had everybody we had the vice president from Fannie Mae come from present in our club. We've had people that do remodels of garages present in our club. Just everybody and all in between. We've had a really impressive number of people there, and it's all on YouTube now too.
That's awesome. People should check that out. And at the end, we'll go over and in the on YouTube and things like that, wherever we put this, we'll put links for everybody. What do you like, Dan? What's your you see so many different things come through. What are the things that stand out to you? What do you think separates one sponsor from another? How, yeah, and then like, there's the sponsors and then there's the deals, right? You know what I mean? So there could be a sponsor that you like a lot, but a deal maybe you don't. So let's have that conversation. What are those attributes that kind of stand out for you that you look
Yeah,
for?
there's a couple of different ways I could take that. I have a system where I have 5 pillars of risk that I usually evaluate when looking at a deal. And then the other really one of those pillars is the macroeconomic, environment. And frankly, that is one of the pillars that is the most important. Knowing over the past even 5 years, the environment has changed so drastically with COVID, with interest rates, with rising and falling of residential housing prices, that you really need to keep your eye on the macroeconomic environment and to know what's coming up and to have informed people, talk to you about what's coming up, because knowing what's coming up should guide all of your investment strategies. And we tend to be long hold investors. So we will buy an apartment complex. We'll tend to hold it for 4 to 7 years. If we can hold it longer term, I love to do that, because if you can pay all the investors their money back, then they're into the deal at a zero basis and just receiving a cash flow. So we actually have a couple of properties where we've done that. But most of them, it makes sense to sell them. So we'll do the renovations and then we'll sell them.
Okay.
In 2025, I think the market is changing significantly. And we at the club actually just launched a club fund in order to take advantages of the trends that are happening in 2025 and continuing on. And the theme of the fund is non-correlated passive strategies that and find institutional quality players that are offering them. So so for instance, DLP Capital is fairly well known, I think, in a lot of investing circles, and they were our very first investment in the fund. The reason why they were is they have a debt fund. And now in 2025, and particularly after the pandemic, and after a lot of bridge loans caused multifamily operators to basically not give good returns on to their investors. So in the last 2 years, we've had a number of distress in the market from multifamily investors who had a floating rate interest rate or a bridge loan or something where there wasn't a fixed interest rate. And those projects didn't do so well. And there were a lot of investors that got burned. And so what we're trying to do is identify really high quality people that have large minimums. The LP Capital, for instance, their debt fund has a $200,000 minimum. And then we will turn around to our club and say, hey, we've got this high quality institutional player. Their minimum is 200,000. But if you come in through the club, our minimum is 25,000. And if we get 8 people together after DLP speaks, we will take that money and put it into, that deal. And so the club's goal then is to identify the best speakers that come in that have non-correlated, differentiated business plans and invest together as a club in order to put together a solid fund.
Yeah. I think that's a great way to run a kind of a capital allocation fund like that, and where you're allocating equity or debt, but it sounds like equity mostly in this position. In order to find those really quality deals that, you need to have a network in some sense. I mean, the DLPs, I mean, they're around. They're our primary lender. We do a lot of business with them. Great reputation.
Well, let me tell you why they were our first investment. They have a 90-day redemption period, which means,
well, it's on there.
Which is great. Yeah, it means that anybody that puts money into the club fund, I can immediately throw it into DLP Capital. It gets 9 to 10%. They have given a regular, return like clockwork on a monthly basis since 2014. And I can throw it into there, get 9 to 10%. But when another opportunity comes along, like we're partnering with a group that's doing prefabricated modular construction in Austin. and they're offering around a 20% IRR. So they've got a better return than DLP Capital, but they're going to lock up the money for 4 to 6 years.
Sure.
So we can accumulate the money in DLP, get a good return, and then sell off a portion of that position in order to move into a longer term position. And I can use that in order to provide liquidity to the fund. So if somebody at the alternative investing club says, "Hey, I want to, sell my portion of the fund," I just turn around and sell a little bit DLP Capital, which is, our high liquidity position, and we can, return that investor's money and the upside that they've earned.
Wow. So talk to me about how we've had this conversation before. You were doing SPVs and things like that. I mean, talk to me about kind of the story of how the fund came up, and just the group making investments and things like that.
Yeah. So we started basically with speakers coming in every Friday, and we still have speakers coming in every single Friday at noon Pacific time. And I would go ahead and on the side, I would evaluate deals, and if I found one that I thought was good, I would bring it to the group and say, "Hey guys, what do you think of this deal?" And show it to people, and people would either like it or they wouldn't. And so the club itself was purely educational, but we were all building a network where we can go in and invest with each other. And so the club itself has completed 14 syndication deals now,
Wow.
and now we've created our own fund in order to do it together.
And you mentioned kind of your 5 pillars of risk. Would you mind getting into those? Is that something you would share? And then I'm curious too, just to some other, kind of how you do the due diligence and things like that. I think that'd be very helpful for the audience to understand. Okay, here's a deal that you like. What do you do after that?
All right. So the very first pillar, of course, is sponsor. Sponsor is the large, and these are what I call the pillars of risk. And my investment philosophy is, unlike standing in the 10-year Treasury bond trading pit in Chicago, where risk was all you had there. Right, it's all you had there. Now, the goal of passive investing is to find predictability and capital preservation. That is the number one goal. And if you can do that and have a reasonable business plan and business narrative, a story on why you can grow the investor's money, that's what you want to look for. You want to look for someone who's minimizing investment risk and has a good plan for growing the investment or the business. And so the pillars of the first pillar is the sponsor. And the sponsor is the largest risk in any deal. They're the one who things that I find out about sponsors in retrospect are, it's important to know, how they make their decisions. And I'll give you an example of that. I have met sponsors who some are better at communicating, some are not, but even ones that are really good at communicating, let's say that they get into a situation where they can give a distribution, and maybe it's time to do that, but they also have renovations they need to do. Sometimes I've seen, sponsors say, "Hey, let's give a smaller distribution out now, enough to keep people happy, and put the rest of that towards, renovations." And then if they get a little more pinched there, then they have to make a decision, right? Do I give the distribution or do I put it towards renovations? And that's when you can start to see exactly how a sponsor thinks. Sponsors that'll put it towards the renovation will say, "Well, this is for the good of the project. Our investors are going to get a better return in the long run. Now, yeah, we're fixing it up now, and it's going to capture more rent. It's going to be better in the long term. So we won't do that." But sometimes that's not the same decision that the investor makes. The investor wants to see, a regular monthly distribution.
Sure. Yeah.
And getting that regular monthly distribution might actually cause the overall return to go down. And so some sponsors will say, "Oh, I'm going to keep that money in the business. We're going to work on the business, give a better return at the end." Some will say, "Oh, no, I want to be regular, repeatable, predictable." And I have fallen into the category of liking those that are regular, repeatable, and predictable, simply because cash flows is a sign of a healthy deal.
Sure. Then there's a risk associated too. You know, when you're getting money out of the deal now, you're in a better position. At least you're getting something back than waiting for it all in the long run. So that's a really good point and gives some really good context to kind of what you're looking for. I like that a lot. So
The second pillar, should I go to the other pillars?
yeah. No, please do.
Second pillar is market. The market, you have to know what the macroeconomic market is. And in particular, in 2025, we're seeing a lot of distressed multifamily and commercial properties. The sectors that are doing better, for instance, are industrial. Retail is actually doing surprisingly well in a lot of strip mall type environments and one-off smaller environments, not necessarily malls, but
the non-grocery anchored retail.
Exactly.
Yes,
those are doing fairly
I'm liking that a lot right now.
One of the other sectors that we like a lot, and that's why we have it in the fund, is prefabricated or modular construction. And so this is a technique where the houses that are built look just like normal everyday houses, and they're sold at market prices, and nobody would know that they're constructed differently unless you asked. But they're basically constructed in factories and warehouses to very exacting, precision. They have better due diligence because they're all built in one location, instead of being built on site. And then those portions of the house, maybe 3 or 4 of them that are pre-built, will come out of the factory, put onto the site, and then you'll assemble 4 of them together. And the advantage there is that you have a great business plan. And that's one thing we need right now in 2025. A lot of syndications have stopped giving distributions. The ones that are giving distributions have a reason more than just renovations. They have a plan like prefabricated housing. The prefabricated houses are usually completed in about half the time of a house that's built on site and at around half the price, which gives them plenty of margin to sell into a market. If the market is dipping or going down, they can lower their prices and not be hurt as much as a lot of other people. And that's a great story.
Yeah.
Another great story is debt. Of course, debt funds. They're contractually obligated and you get regular income on them. We also like tax abatement deals. So one way to drive value in a commercial property is, for instance, we partnered on a property in Houston that was a little over 400 units. And the city of Houston was offering a deal where if we said that 30% of the units would go to people that have 80% of the area median income, and 20% of the units to people that have 60% of the area median income. And there is a lot of negotiations on, who gets how we choose those people and how we keep that running well. But if we were to do that, then we'd get a 99-year tax exemption. And in Texas, the largest tax there is the property tax. There's no income tax. Property tax is the big one. And so having a 99-year exemption, plus if we resell the property, the next owner only has to pay 85%, or gets an 85% exemption. They pay 15% of the taxes.
Nice.
So in our case, we were going to do a light renovation here, and this was a beautiful A-class apartment. This was like jaw-droppingly a nice apartment complex. And we were going to do light renovations on the inside, but really the main business plan was get that tax abatement. Suddenly 30% of our expense, budget disappears, and we have the room to give an investor return.
Wow. How do you balance the macro market versus the micro?
What do you mean by the micro market?
I mean, just because I see it now, like when we invest, like there's like we're investing in urban metropolitan areas where there's pockets of the city that are vibrant. There's community investment. There's homes being redeveloped, and then there's other. The pockets can be very different. Leaning more towards Class A to Class C. Depending. That kind of thing where you're at. That kind of stuff. So I always think it's important to kind of balance. the overall picture and the overall positive or negative of, trend in whatever the investment is, and the overall kind of supply and the demand, but to look at the area itself and look at the supply and demand and what those value generators are in the specific area that you're investing in.
Mm-hmm. Well, we only invest in B and maybe A minus type apartments. We don't invest in C class apartments. We don't invest in D class apartments. And so your B class apartment is going to be your working professional, your person who's got like a white collar job. It's not a top of the end apartment community. Maybe it was a top of the end apartment community 20 years ago.
Sure.
So at that point it needs a little bit of renovation, a little bit of updating, and there's an opportunity to put some work in and reap a profit. So looking for a particular type of buy box is really the key in that particular case. Making sure that you're there on site. You actually, you're not just a remote investor, but you have somebody who's a boots on the ground. Every person that we do a deal with, or every deal that we have done in the club, has always had a partner in the deal that is local to that area and who can directly manage it.
Yeah.
And so that is critical. We always have a partner who is local, no completely remote places. But what that does is it allows our club to have the flexibility. I mean, our club is invested in 10 different states right now. My tax return was 273 pages.
I can imagine.
Yeah, state because of all the state returns.
Yeah.
And so it gives us more flexibility in terms of looking in different locations, diversifying across geographies, diversifying across different asset and operators. But it's always important to have that local person there.
Makes a lot of sense. So we got the sponsor, we got the market. What's number 3?
The business plan. Number 3, what if you have the market as a headwind or a tailwind rather, and the managers passed the test and have done it before, they've given good investor returns, they've taken a couple of properties full cycle, then you want to look at their business plan. And a lot of business plans, frankly, all look the same. You go to these syndication groups and they're doing their investor pitch, and we're going to go in, we're going to do renovations, we're going to raise the rent by $200, and that's how we're going to make a profit. Well, those deals are squeezed right now. And so that particular business plan doesn't really cut it in the current environment. There are, deals where it can cut it, but there are just fewer of them currently.
Yeah.
And so what is the business plan? Is there a tax abatement? Do you have a university nearby? Do you have we were looking at a property in Tallahassee, Florida during the middle of COVID. And we really liked this property because Tallahassee, the 3 largest industries in Tallahassee are government workers, university, and healthcare. And all 3 of those do just fine during the middle of the pandemic and even during the middle of a recession. And so we were looking at what's the business plan here in order to attract these people. So having some novelty is important. Being in the right market is important. Having the right people is important. And then the 4th pillar is, and actually probably the one that constrains me the most, well, maybe not the most, the regulators. Are you in a business-friendly environment? And that can make a huge difference. We saw people in California during the pandemic have, renters who didn't pay rent for almost 2 years.
Sure.
I don't know how you can survive that as a business owner. A lot of people didn't.
Yeah.
And then we also had a property in Alabama, which goes all the way the other way.
Sure.
I actually found out from our lawyer we can technically, jail people for not paying. We don't do that, but there's a 15-day eviction process.
Okay.
And quite a few states have a shorter eviction process. Most of them aren't 15 days like Alabama, but
that's a homeowner or a landlord friendly state there versus like a tenant friendly state like California.
We tend to invest in the Midwest, in Florida and Texas. We actually have a couple of properties in the Phoenix, Arizona area. So we tend to stay out of, the coastal areas.
Mm-hmm. Okay. So number 5, did you save the best for last or what?
The best is for last. Actually, those are the four. I would say that those are the four big ones you need to look at.
Sure.
Number 5 is really more the investment itself. So not just the business
The
plan,
terms,
terms.
how long it is, minimum investment, kind of
Right.
when you're getting paid, waterfall fees, that kind of stuff.
So one of the things I like about our club's fund is we have a 3-year lock-in period. And that was a goal of mine in order to get that, because a lot of the deals we had done before in the past are syndication type deals where you have 4 to 6 years. Your money's tied up for that amount of time. And being able to invest in multiple projects within a single fund means that we can balance the liquidity of the fund in order to get people to a point where they can buy in and out of it with a 3-year period. There's also oil and gas deals, which I tend to like a lot right now.
Well, that was going to be my next question. You mentioned the correlation, and filling the fund with non-correlating, investments. Talk to me about, what you're looking for there. And I've heard that a lot lately. I keep hearing that over and over again. So I'm curious to kind of hear your insight into that, and how you're doing that, and then how you're making sure things aren't correlating and stuff like that.
Well, so these investments you're never going to get an investment which is completely non-correlated. But here are the 5 strategies that we use. The first one, like I said, is a debt fund. So that has great liquidity, 90-day liquidity, regular clockwork-like distributions. So it meets all the cash flow requirements, and you can get in and out of it quickly. So that was our foundation level. The second project that we invested in was actually in something completely different. We invested in business equity in SaaS companies, software companies. So a lot of people at the Intel Real Estate Club knew software fairly well. And we found an operator who was experienced in buying software companies and basically 3 to 5 or 10xing them. And so our second investment was actually in business equity. And that's an area I think as a club we're going to be growing a lot, because right now we have the silver tsunami. There are a lot of people that are retiring, and if they're not selling their businesses basically just disappear. So they may as well sell them to somebody and get the money for that and retire. So there's a lot of that going on right now. The third pillar that we have is prefabricated modular construction. So do you have a business plan that can get you to market faster at a lower cost? The fourth that we're working on right now is in the industrial space. So industrial flex properties are doing quite well. And in my opinion, it's a good time to be picking up the deals that you can find in that particular space. And the reason why I like them is they're triple net leases usually, which means that the tenant will pay the expenses, they'll pay the taxes, they'll pay the insurance. So you as the owner, you basically need to do lease negotiation with them and some overall maintenance on the property. But it's about reducing your risk, right? If you're not paying the expenses, that's a large risk reduction that you're making.
Sure.
So those are doing well right now. And then the fifth that we're looking at, we're actually looking at 2 different industrial groups because we like that sector.
Interesting. Yeah, that's fascinating. It's just, that sounds like a lot of fun. You know what I mean? I like when
Yeah.
you you got to be having a lot of fun, right? What's your biggest kind of change from working at Intel full time to doing this? What would you say you like about it the most, and then what would the opposite? What would you say maybe is the most challenging?
Well, at Intel, I was in my cube all day programming, and I actually got out of that and I started becoming a software trainer. So I would teach other people how to use Intel's products, and I really enjoyed that. And frankly, that skill
You said we learning some skills there to what you do now, right?
it's very similar, to be honest. It is a complicated, software engineering and investing in real estate and passive investments are both complicated topics, and you need a club or a person from Intel, a trainer of some sort, to come and make those topics easily understandable to people.
Yeah.
And that's really what my passion's been. When I was working at Intel, we were explaining software. Working at the investment club, we're interviewing people that do investments all the time. And we're learning from some of the best people, some of the, not everyone's the best, but we have a lot of good people in there. It's the fun of getting to meet people, see what they're doing, understand their strategies, and bring that to the working person who doesn't have the time to do the research themselves. I get an enormous amount of satisfaction. I keep a file of every nice comment that a person in the club has sent to me. And it's a little over 22 pages now of just quotes that I throw in the file of, hey, Daniel, I bought my first rental house. Hey, Daniel, I bought, I had a lady from Ethiopia who worked at Intel, been here for 24 years, and said, Daniel, I bought my first 7 rental houses. It's like, wow, that's amazing.
It's amazing.
So just people who have begun their investor journey and are enjoying their own personal development. Becoming an investor is not just about growing your money. It's about growing yourself, personally. It's about growing your education, and it's about growing your community.
Yeah.
I love the fact that I'm not sending my money to Wall Street. I'm sending it to the apartment complex that's down the road. It's part of a community.
Sure.
It's not on Wall Street.
That's amazing. Well, you're speaking my language, because I'm a big believer in everything you're saying there. It's in dealing with thousands of accredited investors over the years and just so many conversations and people with different backgrounds and things like that. It's not all about the money, it's the self, the health, wealth, kind of looking at it holistically. And, that's and finding purpose in your investing is when you've reached a whole new level, right? You know what I mean? It's just, that's amazing. How can people learn more, Daniel? How can they get involved? Give us some information there.
Sure. Alternativeinvestingclub.com is our website, and we have meetings every single Friday at noon Pacific. Everybody's welcome. It's open to the public. You just go there and put your email address in. We'll send you a calendar invite. And our club fund, if you go to alternativeinvestingclub.com/fund, you can see all the details for our fund and how we invest in different non-correlated passive opportunities. And I think the best thing you can do is just come and be part of the Friday meeting. We also have forums and online discussions at the website as well. We've got a pretty active community of around 1,300 people.
Wow.
And just come to the website. You'll find everything you need.
That's amazing. Well, you've built quite the community, and now you're on your way building the fund. Very exciting stuff. I thoroughly enjoyed this conversation. Thank you so much for being with me, Daniel.
You're going to be our speaker this Friday. You're already speaker this week.
So I'm looking forward to that. I'm happy we had this conversation beforehand too, because it gives me so much more insight into the community and kind of how to approach a presentation and things like that. Because one thing where else, there's a lot that we have in common, but there was one thing that you said, that was my philosophy in investor relations and raising capital and dealing with people is meeting them on their level. And I've seen a lot of times over the years where operators and sponsors, who are in the thick of it every day after day after day, it's hard sometimes to remember the person you're talking to may have very little concepts of the definitions and the day-to-day that you're doing, all that kind of stuff. You have to, and I feel like in order to do that, you have to ask the right questions. It's all about questions, right? You know what I mean? Like, you've been given some really great context and questions for an investor, an LP, somebody on the passive side to ask. But it's important too for sponsors to ask the right questions, understand what is somebody's experience. You're going to build rapport that way. And this isn't like a manipulative thing or anything like that. I mean, this is about finding out where they're at in their life and what experiences they've had, what their goals are, what they're investing for, all that stuff.
I read this book, and I'm going to highly recommend it to anybody who's into connecting with their customers. And it was called I think it was the Dan Sullivan question. Okay. His question was, if you were looking back 3 years from now what would have needed to have happened to make you happy with your progress financially and personally? And you ask somebody that during your introduction meeting, and it will open up a world of discussion. You say, I want to raise money for my kids to go to college. I want to retire. I'm new at my job and I'm saving up for my first house. You get to hear all the stories of why an investor wants to invest and what they think the next 3 years, what would make the next 3 years successful. It's a great question to ask level, and it just opens up, the fountain of whatever they want to talk about.
Yeah, that's great. Awesome. Well, it's such a great conversation, Daniel. I hope to have you back on sometime. I'd love to watch the just the group and see as it grows. And how long have you been full time in the group? When did you leave Intel?
March 15th, 2023.
Oh, okay. So this
Year and a half or so.
yeah. I mean,
We ran it internally to Intel for 4 years, and
it's amazing.
yeah, I exited. We started a fund. We started, all the different groups that we have that are kind of subgroups within the club. Also, we've got a multifamily group and a short-term rental group and due diligence group and things like that.
Wow. Well, there you go. I mean, this is so many different things. I strongly suggest people go over and check it out. And I'm looking forward to presenting to the group. And this was a great
We got
conversation.
to bring a slide presentation. I used to be lenient on it and say, hey, let's just come in and talk. And then the group actually voted that they want.
I like the slides. I mean, I'm a slide guy. It gives you something that's a good foundation for a
It
presentation.
is, yeah.
You know what I mean? To have some to look at, so you don't have to look at my ugly mug for too long at any given time. But I like that. It just kind of makes it visual. But from my perspective as the presenter, I like to have a place to come back to, because I'm the kind of person where I can go off and this and that. So it's like, what am I saying again? I go back to the
Yep.
slide. That's what bullet point up.
I think the club actually voted for that after we had one person come in and their talk kind of meandered a little bit.
Yeah.
I came to you like, oh, we want slides.
My partner Ron could be that way, where he'll go all, like, one question will just snowball off onto all these things, and the slides definitely keep you on track. And it's all about making sure that people that the expectations are met. And I think that's where talk about questions and things like that. I mean, it's so important on both sides of the spectrum. It's just asking the right questions to kind of lay out what are the expectations and all that kind of stuff. So awesome. Well, Daniel, I appreciate your time, and really enjoyed talking to you, and looking forward to the success of the group moving forward and all. It's you got some really awesome stuff going on.
You too, Peter. I'm looking forward to you coming in and talking too.
Awesome. Thank you so much,
Okay.
Daniel. Have a good one.